So we've gotten through what would have been the biggest question mark for the year of cuts were supposed to start in March. As of the first week of January, cuts were supposed to start in March. Obviously, that didn't happen. We've gotten through it and we survived it. And we have a first quarter earnings season under our belt that's stronger than was expected. So I think the market is looking at that and saying, you know what, maybe we get through this.
On the Tape is presented by CME Group, where risk meets opportunity. iConnections, reimagining how the investment industry connects, and SoFi. Get your money right all in one app. A warm welcome to the final, I think it's the final, On the Tape podcast on a Monday for the month of May. Guy Adami, always joined by EY from SoFi. By the way, today Dan Nathan is also sitting down with Jan van Eck, the CEO of Van Eck, and Matthew Siegel, head of digital assets research at Van Eck. Bitcoin, regulation, semis, hedging for calamity. That's a great conversation, so stick around for that. And by the way, we got a bit of a tease here, Elizabeth. Wait for this. Have you heard this? Check this out. You ready?
I'm ready.
Well, and apparently you're not, because Risk Reversal's Market Matrix, our new AI-generated podcast, breaking down the day's most impactful market and business headlines, is coming out. We're an AI bot, too. And I think, if I'm not mistaken, we're calling it Brunson, in honor, of course, Jalen Brunson of the recently eliminated from the playoff New York Knicks.
Oh, bummer. I didn't know that. I wasn't following.
No, you did.
The Pacers, did the Pacers take them out?
The Pacers of Indianapolis, yes, they took them out in Game 7.
Also took out the Milwaukee Bucks. So
the Bucks
I'm
in Milwaukee.
fine with that.
Yeah, so now they're on to play the Celtics of Boston. And before we get to what I think is the most interesting story of the day, will you hold up what's in your hand, please? Yeah. Have you just turned into a 75-year-old dude overnight? I mean, what happened there?
Not overnight. I love pottery. I love like unique mugs. None of my coffee mugs match, but this is my big one. This is my Monday one.
Okay.
Well, all the coffee.
Good to know for any of you folks looking to get Elizabeth a wedding gift. Unique mugs are on top of the list.
Yes,
so
please.
Look, so I think we got to start with, the story. And I guess it was just a matter of time because, with each passing day as the market seemingly goes up and up and up, you wind up having capitulation. Traders have to capitulate. And quite frankly, research analysts and quants and strategists and economists, they all sort of hit their point as well, where they say no mas, sort of the Roberto Duran thing. But it finally happened to Mike Wilson, who I know you have the utmost respect for, as do I. But, he finally said, it's effectively capitulation, and he's looking for stocks now to rally, I think, another 20% or so by the end of the year. Or he raised his price target by 20%.
He had a bearish price target. He raised his target by 20%, up to 5,400.
And we're effectively there now. So, I mean, he just basically said, okay, I've had enough. And here we are. So hard to blame him. I mean, the market has a way of humbling us all. I think, quite frankly, if you really drill down, and I'm sure we're going to have him on the podcast at some point over the next month and a half or 2 months, a lot of the things he was concerned about have not gone away, but, the market just basically, beats us all into submission at some point. So thoughts on that?
Yeah, I mean, yes, absolutely. Utmost respect for Mike, and still not the highest price target on the street. Belsky now is the highest, I think, at 5,600. And just to be clear too, I know we talked about this, Dan and I talked about this on Market Call last week, even though Belsky raised his price target to the highest on the street, that still includes a correction between now and year end, and a bigger correction than what he was expecting previously. So I think another thing that Mike said when he raised his target was that the environment has become much harder to predict. I mean, it's always hard to predict as it is. And I'm guessing, or I'm going to presume, I don't want to put words in his mouth, but exactly what you just said, where many of the things that we would worry about, such as the yield curve in the longest inversion ever, the fact that we've raised rates so much and it doesn't seem to have a negative effect yet. It's, this tightening period hasn't had the negative effect that everybody would have expected it to. Inflation having been so high and still not deflating hasn't quite taken the big bite that we thought. There hasn't been a refinancing issue. There hasn't been defaults. All of those things that would have usually or traditionally happened in an environment like this just haven't. So I think that's where the difficulty in predicting comes in the sense that it's not necessarily never, but at this point, many of us would have thought that some of these negative pieces would have already reared their ugly head, and they just haven't. So I think surprised by the resiliency of the market, surprised by the resiliency of the economy, surprised by the resiliency of spending, and just where is the money coming from? Question mark. And that all of that I think has been a surprise and has made this cycle so much more difficult to see through.
Well, the money, I mean, you know this, I know this. I mean, the money is coming from just credit expansion in the form of, credit card debt and those types of things. So, we say it all the time, never question U.S. consumers want to spend. My new concern, or, one of the many concerns is, they're spending on credit to combat inflation. And, you listen to Jamie Dimon, and I don't know what agenda he has, if at all, but, he continues to sort of be out there talking about the persistence and this sort of this unslayed dragon in the form of inflation. And he's clearly concerned about it. So, when the most important banker in the world continues to sort of stoke whatever flames he's trying to stoke, I mean, you have to take notice. But to your point, the market hasn't cared. And I thought by this time last year, by mid-spring, early summer, we'd start to see some of the impacts, some of that, I guess, lag effect kicking in. We're not seeing it, quite frankly, at all. And it's perplexing to me. And I still think there's an inevitability to this, but the market doesn't seem to care. And I'll say this as well. Now we're approaching June, and we're talking about, again, an inverted yield curve at historic rates. With each passing day, it makes a new record. I think surpassing that, 78 to 80 or 79 to 81 or so, as you pointed out a number of times. But that is seemingly forgotten as well. I can't remember the last time, Liz, anybody was talking about the inversion in the yield curve and what the re-steepening, if in fact it ever happens, will mean.
It's funny. I just said to Mario last week, so have we gotten to a point now where we're just expecting the yield curve to stay inverted forever? This
Right.
is now normal. Like, this is how it's supposed to look. Is that just what this is? And you know what else is funny? Shout out to Helene Meisler. She's got a pinned tweet on her profile that says nothing like price to change sentiment. And it's interesting how I think this is playing out right now, where you've got everybody turned into a bull, right? Because price has continued to rise, things have continued to be okay, and people look at it and say, well, obviously, I mean, we had all this stimulus and consumers are still doing fine because wage growth is still healthy, people are employed, of course they're going to spend, the economy is stronger than we thought, growth is happening, productivity is rising, right? So it's easy to look at it when things are good and say, well, obviously this is working. I'm willing to bet that if things turned the other direction, the same explanations would work in the other direction.
Right.
Where people would say, well, obviously this was going to be a problem. We raised rates 525 basis points. We had inflation above 9%. The Fed has been trying to kill the economy. They finally succeeded. So that the narrative would shift exactly with the sentiment in the market. At least that's my assumption. And that's why I say shout out to Helene, because it does happen pretty quickly. And it even happened in that AAII survey that we've had. It turned bearish about 3 weeks ago when the market was having some trepidation, not sure how earnings season was going to shape up. And then very quickly last week, it was bullish again because we blew through the all-time high. We blew through an all-time high on the Dow. And suddenly everybody was like, well, obviously everything is fine.
Well, we should talk about that because you tweeted about exactly that, that survey. I don't know when the tweet came out. It might have been yesterday. I mean, I lose track, but if you're not following Elizabeth on Twitter, you're doing Twitter wrong. But to your point, I mean, you put it out on a tweet that investor sentiment briefly turned net bearish 3 weeks ago, but here we are. I mean, it's amazing. And, think about what happened 3 or 4 weeks ago. And, that fact about price changing sentiment, I get that. And I understand there's a derogatory hint to that. And this is not against Celine or anybody, but, at a certain point, you got to say uncle. And I think, that's what we're seeing here. So the only thing, and I've said this a number of times, when I say price is truth, what I try to mean by that is, you can take all these inputs in and read everything you want, but at the end of the day, the decisions you make are based on where things are trading. So the decision at in the bond market at 5% is much different at 4.4%, right? So, those decisions are based on where things are trading. So that's my point about, price is truth, because again, the only thing you have to go on when you take everything in is where things are trading and where they can go up or down from there. So, that's why this game continues to be so difficult.
Yeah, absolutely. I mean, if there are buyers in the market, which there obviously are, there were buyers for meme stocks even. If
Yeah.
there are buyers in the market, you have to respect it. It's that sort of the idea of don't fight the tide. And momentum is a very, very strong force. It will stay in motion until given a big enough reason to change. And I think we've seen with this market over and over and over again, it takes more than one or two bad data points to change sentiment. And investors will just start to choose other equities to invest in instead of continuing to pile into the same stuff. But so far, we have not seen a rotation out of the equity market. And that's the piece that I think has kept all of this afloat. But it's also something that you have to take note of, and you have to acknowledge the fact that people are optimistic, they want to stay optimistic, and they want the market to continue rising. So as long as there's appetite to buy any little dip, and as long as there's appetite to just rotate within equities, despite bad news that may come in whatever form it is, you have to respect it, and you have to stay invested, frankly.
Yeah, optimism is a huge driver, and again, people want. I get it. I mean, I totally understand it, and with each passing day, and we'll talk about the VIX in a second because I find it fascinating that it closed below 12 last week. We'll talk about that. But Larry Kudlow used to say that profits are the mother's milk of the stock market, and per share earnings profits up 7.3% so far in the first quarter, and basically that's 90% of companies I think have reported. We got sort of, as they say, stems and seeds over the next couple of weeks, but that's the best profit growth I think in 2 years or so. So there's something to take away from that. Again, I don't necessarily know what it's on the back of. I guess to a certain extent, technology is driving the bus here, which we totally get. And obviously, it seems as though some companies are still able to pass on costs to the consumer. But here we are. I mean, say what you want. The numbers are what they are. With 7.3% climb in earnings growth is pretty good.
Yeah, it is. And one of the things that we had been concerned with, meaning you and I and Dan, was that profit margins would shrink as time went on because revenues would stop going up as much. At least this was my take. Revenues would stop going up as much because companies wouldn't be able to justify those price pass-throughs anymore. I do think that it's started to hit a wall, especially in some of the consumer staple type companies or the lower cost type companies, where they can't justify pushing through more and more price increases if they're supposed to be presenting to the consumer as a low-cost solution. So I do think that that's happening, and the companies that have benefited from top-line growth just as a result of price pass-throughs are seeing some pressure from that. The thing that typically happens in a cycle with corporations is because they have to forecast out so far, and because they have to do it on a quarterly basis, it's difficult to get the timing right on managing their own operating margins. And what I mean by that is the economic environment shifts or the consumer environment shifts, and they can't shift as quickly. So it gets to be difficult for them to manage what they've planned for production and inventory and sales and costs out far enough to match what's changing under the surface in the economy, which is usually why you see earnings hit the skids a little bit when the economy is moving so quickly. That hasn't happened, at least not in a broad brush sort of way. I would have expected that to happen in the consumer sectors a little bit more deeply before this. And maybe it's still to come. We had some hiccups with inventory issues last year, but we haven't heard that now. So either it's that all companies have gotten better at managing their operating margins, which I'm skeptical of, or it's the fact that the economy really is strong and supporting the forecasts that companies have made. I do also think many companies got more conservative with their forecasts, and that has served them well.
Now, listen, without question, in terms of inventories, Walmart had that one hiccup, but they clearly have gotten that under control. So, I mean, Walmart to me is well, I mean, it's Walmart specific probably, but it's also a pretty good barometer of what's going on in a myriad of different ways. But what I also found interesting over the last couple of weeks, and all these things are sort of coinciding. 14 out of the 20 biggest stock markets are at an all-time high. That's 70%. I can do that math. Throw that on top of we saw the resurgence of these meme stocks over the last couple of weeks, obviously in the form of AMC and GameStop, which is concerning. And I mentioned earlier the fact that the VIX closed below 12, I think, for the first time in quite some time on Friday. I mean, 11.99, I think, was a close. So I'm splitting hairs a little bit, but you get my point. All against the backdrop of, again, things not getting necessarily all that better on the geopolitical front and all the macro headwinds that we talk about all the time. What do you make of that, if anything, especially the VIX? And we're not here to trade the VIX, but I look at it as a measure of complacency. And if that's the right word, I mean, complacency is at a multi-year low.
I would look at it as a measure of complacency as well. So the relationships, I talk about relationship problems a lot. The relationship that you want to see with the VIX and the market is if the market is rising, the VIX should be going down. If the market is going down, the VIX is likely going up. There have been periods in this cycle where you've seen the opposite happen, and that's when it really raises more alarm bells for me. But this period right now, we have to think about where we are on the calendar. At the beginning of this year, we thought we were going to have 6 cuts. So now we've made it past that March meeting and we didn't have any cuts at all. The market has been able to digest the fact that we might have 1 or 2 by the end of the year. But I think that because yields have come down, we've sort of pushed that away as, okay, that would have been a bigger issue. But since yields have come down, we're not as concerned with it anymore. So we've gotten through what would have been the biggest question mark for the year of cuts were supposed to start in March. As of the first week of January, cuts were supposed to start in March. Obviously, that didn't happen. We've gotten through it and we survived it. And we have a first quarter earnings season under our belt that's stronger than was expected. So I think the market is looking at that and saying, you know what? Maybe we get through this. Maybe this is the soft landing. Maybe companies have done an okay job and the consumer will hold up. And that's why the VIX has gotten so low. So now we're looking for other opportunities. I still see the meme stock thing as FOMO, as in valuations have been inflated in certain areas. So investors are looking for bigger upside wherever they can find it and starting to reach a little bit. But the reality is that we're not as extended as we've been in previous bubbles, so to speak. So we're not at those extreme levels, extremely overbought. And across sectors, we're not extremely overbought. We're frothy, but we're not extremely overbought where it's sending off a signal that says danger.
Barron's had a piece out over the weekend. Think inflation is cooling, think again. And, I've been talking, I know you talk about it as well. I mean, it's coming in all ways, shapes, and forms and things we don't necessarily talk about. But copper, making a multi-year high. I mean, copper's been breaking out right before our very eyes. Then you have some of these other industrial metals, zinc, aluminum, tin. Throw on top of that some of these soft commodities, then overlay it with the fact that crude oil has been lower, I know, but it's been hanging in there. Gasoline prices have been moderating, but I think they're going to start to turn up as well. I mean, inflation, in the form of things that matter are seemingly there. And that sort of harkens back to Jamie Dimon's comments. And it's one of the many reasons I don't think a rate cut is coming to a theater near you. And I'm still one of the few people that think, despite the fact that yields have gone from basically 4 3/4 and 10-year down to what we get there, like 4.35 or so, back on their horse a little bit. I still think the trajectory of yields is higher. So maybe I'm looking at the wrong things, or maybe I'm just searching for something that sort of fits my narrative. But in terms of these commodity prices, it's happening right before our very eyes. I didn't mention gold because I don't view it as a commodity. But by the way, silver over the last week and a half or 2 weeks is probably rallied 25 or 30% as well.
Yeah, and I don't think that is stopping anytime soon. But the real question is when you look at the commodity complex and try to figure out why prices are rising, that's the question that you need to answer as an investor. Sometimes it's because there's a lot of cyclicality in the market. Things like copper are very tied to the housing market. So if we were seeing a huge rally in home builder stocks and we were seeing this huge ignition in building and permits, which we're not, there's a backlog. They're still steady. There's a backlog of homes to be built, but we're not seeing a new ignition in activity going on. So I don't think that the rise in these commodities is due to cyclicality and demand. I think much of it is still due to the imbalance of supply. And that is not likely to go away anytime soon. The thing that would send them down is if we did start to have issues again or worries about a global recession, in which case you'd see the commodity complex probably hit the skids. But I don't think, again, that that's going to happen anytime soon. So when you watch commodity prices rise like this, base metals, I mean, everything, right? Agriculture, some of these little pockets. We had that cocoa craze for a while. The difficulty for companies is that if they are affected by those commodities, it's sort of behind the scenes. It's a few steps down the supply chain. So it's again difficult to explain, well, because copper prices are up or because agriculture prices are up, we have to raise prices on t-shirts, right? So it's going to get more and more difficult to justify those pass-throughs. And I think that will be the story of 2024. But the other thing that I think investors are looking at is less about the pricing pass-throughs. Now they're looking at cost conscientiality in the sense of you're going to get rewarded as a company for being a good steward of that capital. Have you cut your costs enough to protect your own margins, to protect your own moat, and to protect your position in the competitive environment, knowing that what's happening right now is that it's just gotten more competitive?
It's interesting. We have a ton of Fed speak this week, without
Every
question. I mean,
week.
I can
Every
seemingly every
week.
week, but I think the main event this week comes in the form of Wednesday, and I'm not asking you to handicap Nvidia because that's not fair to you. But what I will ask you is the importance of Nvidia, up or down, on the broader market. And I preface that by saying, I thought Apple was sort of the benchmark for the broader market. And as Apple went to a certain extent, the market would go. But, that obviously wasn't the case as Apple traded poorly in the face of a stock market that's doing well. So I guess the question is, will Nvidia buck that trend? Is Nvidia as important to the market this week on Wednesday as I think it is?
What's funny is this quarter, I feel like it isn't as important. And remember the times when Apple was the stock market and we asked all the time. I mean, even on CNBC, we would talk about it. It seemed like almost every show, can the market go up without Apple? And the answer was no for a while. And then it shifted. And now it's become, can the market go up without Nvidia? Now, Nvidia is absolutely ripe for producing volatility if something goes wrong, right? And the enthusiasm that's been around AI and the semiconductor chip craze, it definitely has an influence on that. But I think this quarter in particular, because things have been so strong for the last week and because we've hit new all-time highs without even knowing what Nvidia's earnings were going to be, and still with an implied move of, 9 or 10% on earnings day. So I think the market has already proven in the last week that it's okay without knowing about Nvidia yet. Now, there is potential for Nvidia to surprise to the downside and things would change. But I think that this quarter, it's not as sensitive as it was last quarter. That's not to say that next quarter won't be the same again. But I think because there is so much underlying strength right now and appetite and momentum, I don't think that it's as risky of a report as it has been in the past.
Before we get out of here, more and more people, even Jerome Powell, to a certain extent, is talking about the fact that debt levels are out of control. And I think I'm paraphrasing, but, basically government's got to get their arm around it. Now, more and more people are talking about debt to GDP levels approaching 130%. I'm not mentioning it to scare anybody because it's just, nobody seems to care. But one of the reasons, I still think yields are going higher for that exact reason alone. And if there is some sort of existential risk out there, I think it comes in the form, Elizabeth, of people finally looking at debt levels and saying, this is unsustainable and something's got to give. Quick thoughts on that.
Yeah, I mean, it does seem like nobody cares. And I think because what we've seen over and over again is that it's supposed to be really scary and then the government figures it out anyway and just raises debt limits and continues to print money and continues to issue treasuries. There was a little hiccup last year, about the middle of last year, where it seemed like maybe the treasury auctions were getting weak and they weren't functioning how we wanted them to function. And then that went away and they started to get stronger again. So recently we've had a few that were fine. If treasury auctions start to get weak again, I think that's where that becomes an issue. We haven't seen it yet, but high yields do have the potential to bring that on again. Now, I don't know where it would happen along the curve. My guess would be that it would happen on the longer end of the curve rather than the shorter end of the curve. But that's the thing that I would watch to see if the market started to decide that debt levels were a concern.
Elizabeth, I always enjoy our conversations. You're the best, mug notwithstanding on this. I think it's the final Monday in May, but who knows? I lose track. I mean, what difference does it make, quite frankly?
I'm pretty sure. Yeah.
But when we come back, Caitlin Malin, the COO of iConnections, along with Dan Nathan, who you all know, I sat down with Jan Van Eck, the CEO of Van Eck, and Matthew Siegel, the head of digital asset research at Van Eck, for an interesting conversation. So stick around for that. And remember, Risk Reversal's Market Matrix is debuting. I mean, it's badass. So check it out. Amanda, Jacob, Timmy, everybody will be throwing that out. So be on the lookout. EY, we'll talk soon.
Later, Gators.